Hedging can be easily misunderstood. Most people either overpay and bleed slowly, or they skip it entirely and get wrecked when the market turns. Here's the truth. There is no perfect hedge. Every option has its trade-offs. But if you know what risk you're taking on and which one you're trying to protect against, then you can build a portfolio that takes hits and keeps going. Today, I'll show you when to hedge, when not to, and how to use both sides of the sword, the one that cuts risk and the one that preserves your edge. Hi, my name is Mark Anderson, and I run a zero DTE hedge fund. I've traded zero DTE for over 1,000 days in a row. I create these videos because I've been fortunate enough to build wealth for myself and others, and I want to pass along whatever information that might be helpful in your investment journey. I've been thinking a lot lately about hedging with all the Trump stuff going on, not just how to do it, but when it actually makes sense. Do we always need protection? Or is sizing down and diversifying giving us the same peace of mind with many more fewer parts? I want to walk through a balanced, clear-headed approach to risk. My hope is that if you've ever felt like hedging was too complex or too costly, this might simplify things a bit. Because at the end of the day, hedging isn't about being clever, it's about being prepared. If the market tanks, do you have a plan to protect against your downside? Or are you just hoping it doesn't happen to you? Let's start as simple as possible. The best hedge sometimes is simply just trading on a smaller size. If your trade feels too big, too exposed, don't hedge it. Reduce your size. That alone might fix your problem in itself. It's kind of like wearing two helmets to go skydiving. You don't need more protection. You just need the right sized risk in the first place. The next consideration in hedging is timing. Timing your hedge is one of the biggest traps traders fall into. Just-in-time hedging sounds great. Wait for a signal, the breakdown, that spike in volatility. But by the time it shows up, it's often too late and way more expensive than you want to pay for that hedge. That's why I lean towards what I call a perpetual hedge. Instead of trying to predict these storms, I set aside a small budget every day, around 0.2% or 20 basis points of my account to maintain that constant perpetual protection. It doesn't matter if the sky is blue or cloudy. Every day, small hedges are added to my portfolio to protect against risk. That way, I'm never caught off guard because no one can predict exactly when the market will turn. It's a simple system that ensures protection is always on, without emotional decisions, panic buying, or missed opportunities. Now, let's talk about the tools we use to hedge. There are a lot of ways to hedge, but there are a few ways I actually trust. First, puts directly in the S&P complex. This is the most straightforward hedge. You're exposed to the market going down, so you buy puts in the most liquid instrument that is correlated to the market you're trying to protect against. If your risk comes from the S&P, so should your hedge. You don't buy homeowners insurance to protect against a car accident, and you shouldn't hedge your portfolio with the wrong instrument either. I prefer at-the-money put options or straddles when I want to protect against directional or delta risk, and longer dated deep out-of-the-money puts like 2 delta puts when I want to protect against extreme volatility events and Vega. Just remember, in high volatility moments, execution risk can spike. Markets get jumpy and liquidity dries up. It can be difficult to liquidate these, so this is where the straddle comes in and the Vega protection from those long puts. 2, calls in the VIX complex. When fear spikes, the VIX spikes harder. This is because the VIX represents a volatility squared of the S&P. It moves fast in a panic, so I allocate a small amount of my portfolio, about 0.5% each month, towards 45 VIX calls. These aren't meant to make money. They're just there to protect us if the market explodes and true panic hits. 3, you must dynamically monitor these positions. Good hedging isn't just about buying protection. It's about managing that protection. I use a systematic plan to monitor and monetize these hedges. I'll sell 1/3 at 35 VIX, 1/3 at 40 VIX, and then the rest at a 45 VIX or higher. This removes emotion and ensures I'm locking in protectional gains when they're needed most, not panicking after the fact. Okay, so now let's bust a myth. There is no free hedge. If you're selling puts to finance your hedge, you're not eliminating risk. You're just moving it around. What really matters is the trade-offs that you're taking and that you're aware of those trade-offs. How much return are you giving up versus how much pain you're protecting against. If you lose 3% of your return a year, but your worst drawdown only improves by 3%, that hedge is not worth trading. But if you spend 2% of your return a year and it cuts your drawdown by 10%, that is a smart trade. It's a good trade-off, and I would run that hedge all day. There is always a cost to hedging. The key is making sure the protection you're buying is worth the return you're giving up. You don't need to be a hero who profits during a crash. You just need to be the cleanest shirt in that dirty laundry pile. If the market drops 20% and I'm down 5%, that's a win for me because that protection gives me the flexibility and staying power when everyone else is panicking, and it's the best time to sell options and volatility. And one last thing, have a monetization plan. I don't just buy hedges and hope. I build my exits into the system. I sell off equal parts of my hedges at VIX 35, VIX 40, and VIX 45, locking in gains as fear ramps up. On some hedges, I also set hard profit targets, like 500% of the debit I purchased. So if they spike, I'm capturing those gains right at the top of the spike without having to react in the moment. No guessing, no hesitation, just executing the plan. Because hope is not a hedge, but a good monetization strategy is. Remember, when I say hedging isn't about being clever, it's about being prepared. Well, in order to do that, you need to know what you're preparing against. That daily noise, let it go. Black swans, the rare, devastating moves, that's what you want to protect against. And the best part, tail risk hedges are cheap to maintain and worth every penny. You might ask how? You do this by structuring your portfolio so you own more long protection than what you've sold in risk in terms of contract sizes. Let's look at an example here. You might buy 2 deep out of the money 2 delta put options at a longer duration for every 15 delta short put you sell. Most of the time, these long options just sit there, cheap and quiet, decaying slowly at that further duration. But if the market experiences a crash, a move that no one could have expected, these longs explode in value, covering your losses and sometimes even turning into a profit because you have more long contracts than short contracts and you have more vega. You're not trying to hedge against every gust in the wind. You're trying to build a bomb shelter for the real storm when that unexpected black swan hits. There's an old line in investing. Diversification is truly the only free lunch. And when it comes to risk, it's true. You don't always need a hedge or a trade. Sometimes you just need a better portfolio. Sizing and diversification together reduce risk more effectively than most hedges can. If I can build 3 uncorrelated strategies, each returning 3 to 5% a year, that's a smooth ride, fewer surprises, and fewer reasons to hedge in the first place. I go into more detail about how I diversify my portfolios and my approach around ensemble trading, which I'll link here below as well. So no, there is no perfect hedge, but there is a better way to approach risk. If you know what you're protecting against, choose your tools wisely. Stay honest about the cost and build a portfolio that just doesn't survive. It stays in the game long term enough to win and profit from those hedges. And if this was helpful and clarified some big fog around hedging, hit that like button and subscribe. I've got more videos coming your way on how to hedge like a pro and to keep your mental game strong throughout the process. I'll see you guys in the next one.